I really enjoy the work John Williams does over at Shadowstats. You should really take a look at his charts and his analysis. And he has been saying for quite a while now that a hyperinflation is coming. Stay tuned and find out more now. I just want to say right now, not enough people out there give John Williams at Shadowstats enough credit for the work that he does. Walter J. John Williams was born in 1949. He received an A.B. in economics, cum laude, from the Dartmouth College in 1971 and was awarded an MBA from Dartmouth's Amos Tuck School of Business Administration in 1972. The man does a great work here on Shadowstats. I'm in the Shadowstats site right now. I'm looking at the Shadowstats alternate inflation rate. And this is very good what he has here. Also the alternate unemployment rate. What the alternate unemployment rate here is showing is on the orange line here, the official U3 unemployment rate shows it down around 5% or under 5%. And the Shadowstats unemployment rate right now is running up at around 22.5%. Now, I'll tell you, what are you going to buy? Which one of these figures are you going to buy? Are you going to buy the government's figure of under 5% unemployment? Because I'm going to tell you, the government is messing with the numbers here on this stuff. They got all little tricks that they pull. I'll tell you one of the tricks that they pull. They say there's no inflation because they say, well, a candy bar costs as much now as it did 10 years ago. Yeah, but you know what? The candy bar was this long 10 years ago. And then it was this long, 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 and now it's this long. Right? And so yeah, it's the same, pretty much the same price, but they've shrunken it down smaller and smaller and smaller. They pull these tricks, see? And so nothing's straight with them. They're not straight. John Williams here is being straight about the numbers. His Shadowstats numbers are correct. And it feels like that's what the unemployment rate is in America. That's what it feels like. It feels like it's over 20%. It doesn't feel like it's under 5%. And so who are you going to believe? Are you going to believe John Williams or are you going to believe the government's official figures? I'll go with John Williams' figures any day. He does great work here. Let's take a look at another figure of his here. The alternative... let's take a look at the alternative inflation chart. Now, this one's very interesting. In inflation-wise, just after, if we look here at the consumer inflation chart, just after 2008, we had a tremendous drop in inflation. It actually dropped into the negative, minus 2%, according to his chart. Yeah, I can understand that. The thing is, no, actually, I read that wrong. The official dropped under 2%. He's showing that the inflation rate was around 1.5% at the bottom of the recession in 2008, or the depression. They call it a recession. It was actually a depression. Okay, so it bounced back a little bit. And what he's showing here is something very interesting. He's showing that the inflation rate is starting to heat up and take off again. Right now, in fact. Into 2017, and you should take a look at these charts he has here yourself. You should go to www.shadowstats.com and take a look at this stuff. This stuff is very worthwhile to take a look at. So now let's look at some more of his charts here. He's got a money supply chart that should be interesting. The money supply. And he shows M3, he shows M2 and M1. And it doesn't look like, it looks like they're just basically going along here, according to this chart he's got. The official M3, M3 Shadowstats, M2 and M1. Now, one of the charts I'm interested in right now is the velocity of money. I'm just going to enter this in. And take a quick look at this. I want to take a look at the velocity of money from the Fred St. Louis Fed. Yeah, it still shows it dropping right now. I don't altogether completely agree with this, even though it shows it dropping. I think that the money actually turned around back in. It hasn't really shown it yet, though. But I believe that the flow of money changed back around last summer, and we seen it in a change in the bond market. I'd like to take a check of the bonds tonight and see what they're doing, just for the fun of it. Take a look at the bond prices today. I always like to check this almost every day, especially the 10-year. Okay, the 10-year is running at 2.5% tonight. Okay, it's actually leveled out a little bit from what it was. Let me see here. If we go to the 1 year, take a look. Yeah, it's dropping a little bit. Just in the last little bit. Go 5 days here. Yeah, it's dropping a little bit. That means the price of the bonds are actually going up, because it's an inverse. See, if it drops, it goes up, and if it goes up, it goes down. Okay. So anyway, that's that. I wanted to talk about John Williams a little bit and his great work he's doing over at Shadowstat. So now let's take a look at this. We're going to go to Zero Hedge right here and take a quick look. It says Americans will be the losers in the Fed's dangerous game of chicken. Well, evidently the Fed, it says here, the move implies that the central bank has confidence in the economy, and markets are riding that confidence to push upwards. But analysis of the fundamentals reveals that both the markets and the Fed are missing something. How long can they keep edging each other on without facing facts? It says, based solely on official government data, the economic situation today looks pretty rosy. Unemployment is supposedly sitting at 4.7%, a healthy level by historical standards, according to the New York Times, and Labor Department reported 235,000 gain of new jobs in the past month. Then there's inflation, which the Bureau of Economic Analysis, a sub-branch of the U.S. Department of Commerce, has things to say about. According to the agency, prices rose 1.9% over the past 12 months. That's just 0.01% below the Fed's target rate of 2%. To top it all off, officials say that consumer spending spiked at 3% in Q4 2016. That's all well and good, and it would be fantastic if we could know beyond the shadow of a doubt that those numbers were true. Unfortunately, it's not that simple. It says why government numbers can't be trusted. Now, see, I believe that entirely, and that's why I took you over to Shadowstats, because I believe Shadowstats has more of the true numbers. See, it says here, the U.S. government's official story on the economy is hardly unbiased. With a vested interest in keeping markets calm and appeasing government entities, tend to massage the economic numbers to paint the best picture possible. And I believe that's what they're doing. This is why Shadowstats is so important. The work he's doing there is so important. It says, while the Fed ramps up for yet more rate hikes and the government keeps peddling false hope, is there a way to see what actually is happening in the economy? Yes, thankfully there is, and it's called fundamental analysis. When we analyze the fundamentals, there's very little room for manipulation, assuming we respect the numbers and evaluate them objectively. The truth has nowhere to hide. That said, consider what is happening in the consumer retail sector. Despite the positive tone coming from the Fed and the U.S. government, the latest numbers show retail sales getting clobbered, especially department stores. Massive outdoor retailer Grant Mountain filed for bankruptcy just last week, and the Financial Times reports non-food retail sales are dropping like a stone. This stands in complete contradiction to what the Fed and the government officials are telling you. If the official numbers on consumer spending are this glaringly false, how can we trust anything they say? Again, I point towards Shadowstats. How can we all lose in this game of chicken? Aside from being grossly misleading, here's the real problem with the gap between the Fed and the government's outlook versus reality. The more they push to convince the markets of economic strength, the more they set us up for a crisis. When America finally wakes up and realizes the Fed and the U.S. government were bluffing all along, there will be no safety net to keep the economy from crashing down. So we're essentially caught in a twisted game of chicken. The Fed raises rates and the economy edges upward, with neither paying any mind to what's really going on. A crisis is inevitable, and there is only so much you can do to protect yourself. Securing your savings with precious metals like gold is one of the best ways to insulate yourself from this fallout. The Fed's fantasy will have its day of reckoning, and it looks as though it may come soon. Well, I have to agree with a lot of what they say here. Okay, thank you for listening. Like and subscribe, and we'll see you in the next article. Bye for now.